Welcome back to Wealth Signal. I'm Alex Carter, and what I'm about to share with you today is not a stock tip, not a market prediction, and not a get-rich-quick formula. What I'm about to give you is something far more valuable. The framework that Warren Buffett himself called the best book on investing ever written.
9 out of 10 investors lose money. Not because markets are rigged, not because they got unlucky, because they were doing the wrong thing from the very beginning, and they never knew it. Benjamin Graham figured this out in 1949. He wrote it all down in a book called The Intelligent Investor. And 75 years later, almost nobody has actually listened. This is not a book about which stocks to buy. This is a book about how to think, about the difference between a person who invests and a person who gambles with a brokerage account. Graham called them the intelligent investor and the speculator. And the line between them is not intelligence. It's not wealth. It's not access to information. It's discipline, patience, and a framework. That is what this book teaches. That is what today's video is about. We are going to go through every single chapter of this book. Not a highlight reel, not the famous quotes. Every chapter, with our own take, our own commentary, and how each idea connects back to the one central truth Graham was trying to teach. By the end of this video, you will understand this book better than most people who have actually read it. Before we dive in, if you're the kind of person who wants to actually understand money, not just chase it, hit subscribe and turn on notifications. We publish content like this every single day. Now, let's get into it. Chapter 1. Investment versus Speculation. Graham opens the entire book with this distinction, and it's intentional, because if you get this wrong, nothing else matters. An investment, he says, is an operation that, upon thorough analysis, promises safety of principal and an adequate return. Every single word in that sentence is doing work. Thorough analysis, not a hunch, not a tip from a friend, not a chart pattern you saw on social media. Actual analysis. Safety of principal. You're not trying to get rich, you're trying to not get poor. And adequate return. Not 1,000%, not doubling overnight. Adequate, reasonable, sustainable. Everything else, Graham says, is speculation. Here is our take on this chapter. The most dangerous investor is not the one who knows nothing, it's the one who thinks they're investing when they're actually speculating. When you buy a stock because it went up 40% last month, that's speculation. When you buy because everyone's talking about it, speculation. When you don't know what the company actually earns, speculation. Graham isn't saying speculation is evil. He's saying, know which game you're playing, because the rules are completely different. Chapter 2. The Investor and Inflation. Graham calls inflation a silent thief, and that description has never been more accurate than today. Here's how it works. You save money, you feel safe. But if inflation is running at 5% and your savings earn 3%, you are losing purchasing power every single year. Not in dramatic fashion, quietly, invisibly, until one day you realize your money buys less than it did a decade ago. Graham's argument about bonds in this chapter was revolutionary at the time, and it's still true. Bonds pay a fixed amount, but as prices rise, that fixed amount buys less and less. A bond that pays $10,000 a year sounds great, until inflation has eroded half its purchasing power over 20 years. Stocks, on the other hand, represent real businesses, and as prices rise, most businesses raise their prices too. Their earnings grow, and over the long run, so do their stock prices. Stocks are not risk-free, but they are the best tool we have against inflation. Our take? This chapter is where most conservative investors get it badly wrong. They think holding cash or bonds is safe. Graham is saying, safety is not just about avoiding losses in price.
It's about preserving purchasing power. A savings account that earns 2% while inflation runs at 4% is losing money in real terms. It just doesn't feel that way. The intelligent investor thinks in real returns, not nominal ones.
Chapter 3. A Century of Stock Market History.
Graham does something unusual here. He goes back 100 years and shows you the data. From 1900 to 1970, U.S. stocks returned an average of about 9% per year, including dividends. Bonds returned around 4%. That gap is real, and it compounds over time into something extraordinary. But here's the part most people skip. Those returns were not smooth. Between 1929 and 1932, stocks dropped almost 90%. The post-war boom of the 1950s, the sharp drop of 1970. The market does not go up in a straight line. Graham's warning for this chapter: people extrapolate from recent performance. If the market has been going up for 2 years, they assume it will keep going up. If it's been falling, they panic and assume it will keep falling. But history shows markets are cyclical. Booms are followed by busts. Busts are followed by recoveries. The pattern has repeated for over a century. The question is not whether the cycle will continue. It will. The question is whether you'll be positioned to survive the bad years and benefit from the good ones. Our take? This chapter is a cure for short-term thinking. Every crash feels like the end of the world when you're inside it. But zoom out 100 years, and what do you see? A market that has survived 2 world wars, a Great Depression, multiple recessions, financial crises, pandemics, political upheavals, and still trended upward over time. The intelligent investor uses history not to predict the future, but to stay calm when everyone else is panicking.
Chapter 4. General Portfolio Policy for the Defensive Investor. Graham introduces 2 types of investors in this book. The defensive investor, someone who wants stability, peace of mind, and doesn't want to spend hours analyzing stocks. And the enterprising investor, someone willing to do the work to earn above-average returns. Neither is better. They require different strategies. This chapter is about the first type. Graham's golden rule for the defensive investor: always hold a mix of stocks and bonds. Never go all in on either. He recommends a range of 25% to 75% in each, with 50-50 as the default. Why? Because when stocks crash, your bonds hold steady and give you something to rebalance with. When bonds lag, your stocks carry the growth. The balance removes the need to make the one decision that destroys most investors: the decision to get out at the worst possible time. Our take? This is the most underrated chapter in the book, because most people skip straight to stock picking. They want to know what to buy. But Graham is saying, before you pick a single stock, decide what kind of investor you are. Know your temperament. Know your time horizon. Know whether you can stomach watching your portfolio drop 40% without selling. If you can't, you need to be a defensive investor, and there is absolutely nothing wrong with that. A 50-50 portfolio, rebalanced once a year, has historically beaten most active investors over the long run.
If you're finding this breakdown valuable, hit that like button right now. It takes 1 second, and it helps this content reach more people who actually need it. We're only halfway through the book. Let's keep going.
Chapter 5. The Defensive Investor and Common Stocks. Now Graham gets specific. He gives you 6 criteria for selecting stocks as a defensive investor. 1. Adequate size. Invest in large, established companies, not startups, not microcaps, companies that have proven they can survive. 2. Strong financial condition. Current assets should be at least twice current liabilities. The company must be able to pay its short-term bills without breaking a sweat. 3. Earnings stability.
The company should have made a profit every single year for the past 10 years, not 9 out of 10, every year. This proves the business can survive recessions, crises, and bad markets. 4. Dividend record. The company should have paid uninterrupted dividends for at least 20 years. This is a powerful filter. A company that has paid dividends for 2 decades through wars, recessions, and crashes, that's a company with real staying power. 5. Earnings growth. At least 33% growth in earnings per share over the last 10 years. Not explosive growth, just steady, reliable, upward movement. 6. Moderate price ratios. The price-to-earnings ratio should be no more than 15, the price-to-book ratio no more than 1.5, and if you multiply the two together, that product should be under 22.5. Graham was essentially telling you, don't overpay. The price you pay for a stock determines your return almost as much as the quality of the stock itself. Our take? These 6 criteria sound simple. They are not easy to apply. In any given market, very few stocks will pass all 6, and that is exactly the point. Graham is not trying to give you a list of hot stocks. He's trying to narrow your universe to the genuinely strong, genuinely cheap ones. Most investors do the opposite. They chase whatever is exciting. Graham says start with what is boring and safe, and only buy it when the price is right. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. Before Graham tells you what the active, enterprising investor should do, he tells you what they should never do. This is one of the most valuable parts of the book, because the things he warns against in 1949 are the exact same traps people still fall into today. Do not invest in new or unproven companies. Most startups fail. Do not invest in hot industries just because they're hot. When everyone is talking about something, you're almost always too late. Do not trust companies without strong financials. If the profits aren't there consistently, the story doesn't matter. Do not buy IPOs blindly. Companies go public at a premium. The excitement inflates the price. And do not rely on forecasts or predictions. No analyst can consistently predict the future of the market. Our take? This chapter is a masterclass in what not to do. And the reason it's so powerful is that Graham isn't making these up. Every one of these traps has destroyed fortunes. The dot-com bubble was people ignoring this chapter. The crypto crash was people ignoring this chapter. The SPAC craze was people ignoring this chapter. The intelligent investor learns from history rather than repeating it. Chapter 7. Portfolio Policy for the Enterprising Investor. Positive Approach. Chapter 7. The Positive Side. Now Graham tells you what an enterprising investor should actively pursue. 5 main strategies. First, buying undervalued stocks. Companies priced significantly below their real worth. Graham called these bargain issues, stocks where you're essentially buying $1 for 50 cents. Finding them requires deep research and patience, but the upside when the market recognizes the real value can be enormous. Second, special situations, mergers, restructurings, spin-offs, liquidations. These events create temporary dislocations in price that a disciplined investor can take advantage of. Third, investing in relatively unpopular large companies. Big companies that have fallen out of favor. The crowd hates them. The price has dropped. But the underlying business is still solid. These are sleeping giants, and when they wake up, the returns can be extraordinary. Fourth, net stocks. Companies where the liquid assets alone are worth more than the entire market cap. You're getting the business for free. Rare today, but the concept teaches you to think about companies as assets, not just stories. Our take? The core insight of Chapter 7 is this: being an enterprising investor is not about taking more risk. It is about doing more work. Graham never says, "Go out and make speculative bets." He says, "Go out and find value that others have missed." The enterprising investor earns better returns not by being luckier, but by being more thorough. That is a fundamentally different and much healthier relationship with risk.
Chapter 8. The Investor and Market Fluctuations.
The Investor and Market Fluctuations. This is arguably the most famous chapter in the book, because this is where Graham introduces one of the most powerful mental models in all of investing: Mr. Market. Imagine the stock market as a business partner. Every single day, this partner walks up to you and offers to either buy your shares or sell you his, at whatever price he feels like that day. Some days he's euphoric. He's convinced everything is going to be great. He offers you a very high price. Other days, he's depressed. He's convinced everything is going to collapse. He offers you a very low price. The intelligent investor's relationship with Mr. Market is this: you take advantage of him when it suits you, and you ignore him when it doesn't. When he's euphoric and offering high prices, you sell. When he's depressed and offering low prices, you buy. What you never do is let his mood determine how you feel about your investments. The moment you start checking your portfolio every day and feeling good when it goes up and terrible when it goes down, Mr. Market owns you. And that is how most investors lose. Our take? Mr. Market is the most useful mental model in investing because it reframes the entire relationship between investor and price. Price is not truth. Price is what an emotional, irrational, easily panicked crowd is willing to pay right now. Value is what the business actually is worth over time. Those two numbers are almost never the same, and the gap between them is where intelligent investors make their money. When you understand this, a stock market crash stops being terrifying and starts being an opportunity.
Chapter 9. Investing in Investment Funds.
Investing in investment funds. Graham tackles the mutual fund question head-on. Most people assume that if they can't pick stocks themselves, they should hire a professional to do it for them. Graham's research showed something uncomfortable. Most mutual fund managers do not beat the market consistently. When you factor in fees, taxes, and trading costs, the average actively managed fund underperforms. The manager isn't adding value, they're subtracting it. Graham essentially predicted the index fund revolution decades before it happened. His advice? If you're going to invest in funds, choose low-cost, passively managed index funds that simply track the market. No guessing, no overtrading, no ego, just the market return, which, over the long run, beats most professionals anyway. Warren Buffett has repeated this advice for decades. The smartest thing most people can do is buy a low-cost S&P 500 index fund and never sell it. Our take. This chapter is humbling for anyone who thinks they can consistently pick winning stocks or managers. The data is clear. Most active managers fail over long periods. The ones who succeed often do so because of a specific edge that is hard to replicate. For the average investor, the most rational decision is also the simplest one. Own the whole market, keep costs low, and stay invested for decades. Graham figured this out in 1949. Most investors are still ignoring it.
We are almost through all 20 chapters. If you've made it this far, drop a comment below and tell me, which chapter hit hardest for you? I read every single comment. Let's keep going. The final chapters contain the most important ideas in the entire book.
Chapter 10. The Investor and His Advisors.
The Investor and His Advisors. Graham's warning here is as relevant today as it was in 1949. Just because someone calls themselves a financial advisor does not mean they are looking out for your best interests. Many advisors earn commissions from selling specific products. They are incentivized to recommend what pays them, not what serves you. Graham's checklist for a trustworthy advisor: competence. Do they understand long-term investing? Integrity. Are they honest when they don't know? Objectivity. Do they push products for personal gain? Alignment. Do they tailor advice to your actual situation? Our take? This chapter is uncomfortable but necessary. The financial services industry has a structural conflict of interest. Advisors are often paid more to sell you complex, high-fee products than simple, low-cost ones. The best defense is education. The more you understand about investing, the less dependent you are on someone else's judgment. Graham's book is essentially an argument for investors' self-reliance, not because all advisors are bad, but because an educated investor who understands the basics will always make better decisions than one who blindly follows someone else's advice.
Chapter 11. Security Analysis for the Lay Investor.
Graham makes a powerful claim in this chapter. You don't need to be a professional analyst to evaluate a stock. You need three things: a framework, discipline, and the patience to actually use it. His three key questions for any stock: is the business fundamentally sound? Has it been making consistent profits? Does it have too much debt? Is the stock reasonably priced? Even a great business is a bad investment at the wrong price. Does it have a margin of safety? Are you buying at a price low enough that if you're wrong about something, you won't lose everything? Our take? This chapter democratizes investing. Before Graham, serious stock analysis was the domain of professionals. Graham said, "Here's how you do it. Any intelligent person who is willing to learn the basics can evaluate a company." The key insight is that stock analysis is not about predicting the future. It's about understanding the present well enough to have confidence in your margin of safety. You don't need to know exactly what a stock will do. You need to know that even in a bad scenario, you haven't overpaid for what you're getting.
Chapter 12. Things to consider about per-share earnings.
This is one of the most practically useful chapters in the book for anyone who reads financial statements. Graham warns, earnings per share is the most commonly cited metric in investing, and it is also the most easily manipulated. Companies can use accounting tricks to make their earnings look better than they are. One-time gains can be included, losses can be excluded. Share buybacks can artificially inflate EPS without any real improvement in business performance. Graham's advice? Always look at earnings over a period of years, not just the most recent quarter. Look for consistency, and always try to understand where the earnings are actually coming from. Are they from the core business or from financial engineering? Our take? This chapter is a reminder that numbers in finance are not neutral. They are presented by the company, chosen by the company, and framed by the company. The intelligent investor reads financial statements with a healthy dose of skepticism, not cynicism, but clarity. Always ask, what is this number actually telling me?
Chapter 13.
A comparison of 4 listed companies. Graham does something unusual here. He analyzes 4 real companies side by side, not to tell you which one to buy, but to show you how to think about the comparison. The companies represent different industries, sizes, and performance profiles, and by putting them side by side, Graham reveals something important. The same financial metric can mean very different things in different contexts. A high PE ratio in a growth company means something entirely different from a high PE ratio in a mature company in a declining industry. Our take? The real lesson of this chapter is that investing requires context. There is no single number that tells you whether a stock is good or bad. It is always a combination: earnings quality, growth trend, financial health, dividend history, and price, evaluated together, not in isolation. The investor who looks at one metric and makes a decision is playing a dangerous game. The intelligent investor looks at the whole picture, always.
Chapter 14.
Stock selection for the defensive investor.
Graham refines and formalizes the criteria from earlier chapters into what is essentially a checklist, 7 rules for the defensive investor selecting stocks. We've already covered the 6 criteria from Chapter 5. In this chapter, Graham adds the critical formula. P/E ratio multiplied by price-to-book ratio must be under 22.5. This combined test guards against 2 different kinds of overpaying for earnings and overpaying for assets. Both are dangerous. Both destroy returns. Our take? The Defensive Investor's Checklist is one of the most powerful tools in this book because it removes emotion from the equation entirely. You don't need to like a company. You don't need to find the story exciting. You run the numbers. Either they pass or they don't. The checklist is unemotional by design, and that is exactly what most investors need. Because most investing mistakes are not made by people who lack information, they're made by people who let their emotions override their analysis.
Chapter 15. Stock Selection for the Enterprising Investor.
The criteria here overlap significantly with the defensive investor's checklist, but with important differences. The enterprising investor can look at smaller companies, can consider companies that have had some earnings volatility as long as there's been no actual loss, and can be more flexible on valuation if there's a compelling case for undervaluation. The core principle remains the same. You're looking for businesses that are solid, and buying them at prices that give you a meaningful margin of safety. Our take? What this chapter makes clear is that there is no such thing as an advanced investing strategy that ignores fundamentals. The enterprising investor has more flexibility, but more flexibility means more responsibility to do the work correctly. A less experienced investor with more flexibility is not an advantage. It's a recipe for making worse decisions. The disciplined use of Graham's criteria is what separates genuine value investing from speculation dressed up as value investing.
Chapter 16. Convertible Issues and Warrants.
This chapter deals with financial instruments that sound sophisticated, but Graham is largely skeptical of. Convertible bonds start as fixed income instruments, but can be converted into stock. They seem to offer the best of both worlds, bond safety and stock upside. But Graham warns, they are almost always structured to benefit the company more than the investor. The interest rate is lower than regular bonds, and the conversion terms often aren't as favorable as they appear. Our take. The core lesson of this chapter is about financial complexity. When a product is complicated to explain, that complexity almost always benefits the seller more than the buyer. Graham spent his life simplifying investing. His message in this chapter is consistent with everything else in the book. Don't pursue complicated instruments when simple ones will do. The investor who understands a straightforward stock or bond will almost always outperform one chasing complex financial products they don't fully understand.
Chapter 17. 4 extremely instructive case histories.
Graham shifts to storytelling here. 4 real situations where investors won or lost based on their decisions. Case 1. Investors in convertible bonds who failed to analyze the underlying company. The bond sounded safe. The company wasn't. Lesson. The instrument doesn't protect you from the business failing. Case 2. A hot electronics company in the 1960s. Sky-high price. No real earnings to justify it. Eventually collapsed. This is the story of every bubble in every era, from tulips to .com to crypto. Case 3. A company with hidden real estate assets. Investors thought they were buying undervalued assets. They were right, but the assets never got monetized. Value that can't be accessed is not really value. Lesson. Intrinsic value only matters if there's a realistic path to realizing it. Case 4. A beloved company whose stock had become overpriced long after its best growth years were over. Nostalgia and familiarity kept investors paying too much until reality caught up.
Our take? These 4 cases are not historical curiosities. They are evergreen patterns that repeat in every market cycle. Recognize them and you avoid the mistakes. Ignore them and you make them.
Chapter 18. A comparison of 8 pairs of companies. A comparison of 8 pairs of companies. Graham pairs up 8 sets of companies, placing a strong one next to a weak one in each pair, and walks through the analysis of each. The purpose is the same as Chapter 13, but more comprehensive. The key takeaway from all 8 comparisons: the company with the better story is not always the better investment. Often, the boring, unloved, apparently pedestrian company with solid financials and a moderate price is the far superior investment to the exciting, talked-about company with weak fundamentals and a sky-high valuation. Our take? This chapter systematically dismantles the narrative bias that drives most investing decisions. We are wired to prefer exciting stories. We are wired to buy what's popular. Graham is showing you, comparison by comparison, that this wiring is your enemy when it comes to building wealth. The intelligent investor doesn't ask, "What's the best story?" They ask, "What's the best value?" Those are almost never the same question, and almost never the same answer. Chapter 19. Shareholders and Management's Dividend Policy. Graham makes a crucial point here that most investors forget. When you buy a stock, you are a part owner of a business. That means management is supposed to work for you, not the other way around. But in practice, most shareholders are completely passive. They don't vote, they don't attend meetings, they don't challenge bad decisions. And management takes advantage of this passivity in ways that cost shareholders real money. On dividends specifically, Graham argues that if a company is not reinvesting retained earnings at a high rate of return, it should pay those earnings out as dividends. A company that hoards cash without deploying it wisely is destroying shareholder value. Our take? This chapter is the forgotten dimension of investing. Most people focus entirely on stock price. Graham is reminding you that a stock is not just a ticker symbol. It's a claim on a real business with real assets, real earnings, and real obligations to its owners. The investor who understands this has a fundamentally different relationship with every stock they own. Chapter 20. Margin of Safety. The central concept of investment. The final chapter. Graham saved this for last deliberately, because after everything else, the analysis frameworks, the criteria checklists, the case studies, the warnings, it all comes down to this one idea. And the idea is simple. Always buy with a buffer. Always pay less than something is worth. Always leave room for error. Because you will make errors. The market will surprise you. Things will not go as planned. The margin of safety is the thing that keeps a bad year from becoming a catastrophe. Graham's definition of investing, that operation which, upon thorough analysis, promises safety of principal and an adequate return, is built entirely on the margin of safety. The thorough analysis is how you determine intrinsic value. The safety of principal comes from buying below that value, and the adequate return is the natural result of buying something for less than it's worth and waiting for the market to recognize that. The margin of safety is not one tool among many. It is the foundation on which everything else rests. Our take on this final chapter: the margin of safety is the most important idea in this book for one reason. It converts investing from an act of prediction to an act of protection. The speculator is always trying to predict, what will this stock do? The intelligent investor is asking a different question. What is the worst case here, and can I survive it? When your downside is protected, your upside takes care of itself. That is the mindset that separates temporary winners from permanent wealth builders. 20 chapters, one idea. That is what this book ultimately is. 20 different angles, 20 different lenses, 20 case studies and frameworks and checklists, all pointing at the same central truth. The market is not your friend or your enemy. It is a mechanism that prices fear and greed. Your job is not to outsmart it. It is to not be controlled by it. The intelligent investor does not predict. They protect. They analyze before they act. They demand a margin of safety before they commit. They stay the course when everyone around them is losing their mind. That is the entire book in 4 sentences. Graham published this book in 1949, revised it in 1972. Warren Buffett, his most famous student, has called it the best book on investing ever written. And the reason it has endured for 75 years is not because the stock market works the same as it did in 1949. It doesn't. The reason it endures is because human psychology works the same. The fear, the greed, the impulse to follow the crowd, the inability to sit still when everything is falling. Those things have not changed, and they will not change. The intelligent investor uses that knowledge as an advantage. If you take one thing from today's video, let it be this. You are not smarter than the market, but you do not need to be. You just need to be more patient, more disciplined, more focused on price versus value rather than story versus hype. The investor who does those 3 things, in any market, in any era, will build wealth. Not quickly, not dramatically, quietly, steadily, permanently. That is what it means to be an intelligent investor.
Now, one thing I want to be honest with you about before we finish. This book is not a book you read once and move on from. Benjamin Graham spent decades building this framework, and what we covered today, all 20 chapters, is a map. It gives you the full picture, the complete landscape. But a map is not the same as walking the terrain yourself. To truly use what Graham taught, this book deserves to be read carefully, slowly, and more than once. And if you want us to go deeper, if you want a chapter-by-chapter series where we break down each of the 20 chapters in full detail, with real examples and full analysis, tell me right now in the comments. Just write deep dive, and I'll know there's enough of you who want it. Because what we did today tells you what Graham said. A deep dive series will show you exactly how to apply it. Before we close, everything you saw in this video, every visual, every framework, every diagram, I designed those specifically to make the ideas in this book easier to absorb and remember. I've put them all together into one visual summary file for this video. If you want to download it and keep it as a reference, I've set up a Wealth Signal Telegram group where the file is waiting for you. And it's not just this video. Every video we've done before has its own file in there, and every new video we release, the summary goes into the group first. So if you want this file and you want to be first to get every future one, the link is in the description below. Join the group, grab the file, and I'll see you in there. If this breakdown gave you value, hit the like button. It literally takes 1 second and it helps this channel grow. Subscribe and turn on notifications. We break down the most important ideas in investing every single day. And drop a comment below. Tell me, which of the 20 chapters hit hardest for you? I'm reading every single one. I'm Alex Carter, and I'll see you in the next one.